Hello everyone, this is Mr. Seymour, and this is Chapter 14, Economic and Social Policy. Economic policies have generated intense conflict in recent years. Both candidates in the 2016 presidential race claimed that they had a better plan than their opponent to help spur economic growth and job creation. Here, Hillary Clinton greets an assembly worker at a furniture factory during a campaign stop designed to draw awareness to her position on trade policy and the economy. The policy-making process involves three major steps. First, you need to define an issue that requires attention. This can be caused by a triggering event or a redefinition of an issue that makes it a more higher priority. Second, you need to get on the policy agenda. This is a list of desired policy objectives and suggested legislation supported by the President and/or Congress. Third, must be debated and alternatives must be considered. Many issues don't get past this stage. Political scientist James Q. Wilson suggests that it's far easier to determine if a McDonald's location is successful. If profits are up, then it's doing well. But the Department of Motor Vehicles is not as easy to analyze. Simply focusing on efficiency rates, such as the number of customers processed per hour, would neglect to account for features like language ability or population limitations. Moreover, there are some factors that the government cannot control. For example, the State Department cannot always be held responsible for the irrational behavior of foreign governments. Policies must be evaluated to ensure the desires of elected branches of government are followed. But how to evaluate government policy is debated in and of itself. There are difficulties in measuring achievements in public sectors policies because there's no profit to evaluate. You must treat all portions of the population equally, and defining success itself can be difficult. The key paradigm in fiscal policy is Keynesian economics, which is the idea that the economy can be fine-tuned through what John Maynard Keynes called counter-cyclical taxing and spending, cutting taxes and raising government spending during bad times and doing the reverse during good times. Fiscal policies are government decisions that regard taxing and spending. Monetary policies are government decisions regarding the control over the money supply and interest rates. Budget making tends to be decentralized at the level of each department, and then within each department, sub-levels. Battles between Congress and the executive branch are common over budget making. While we've treated the President and Congress separately, here it's important to understand that they don't work in isolation. Rather, the ability to work across the institutions is critical to good economic policy. Things can generally be smooth when the President and Congress are the same party, though that seldom happens and most economic fights are very contentious. Right now, the President and Congress are the same party and they still aren't smooth. So even right now, it's contentious amongst the President and his own party, representatives of his own party in Congress. And not one single major bill on the President's policy agenda has really gotten through Congress yet. And we're already almost a year into the first of 4 years of President Trump's time in office. There are public expectations. The public expects a healthy economy no matter what the President and Congress do. The President is unable to accomplish much single-handedly. He needs congressional support, and right now he doesn't have it. Advisors help formulate policy. That includes members of the Office of Management and Budget, the United States Trade Representative, and the National Economic Council, as well as the President's Joint Council of Economic Advisors. Government regulation affects many aspects of our lives. Regulations may be aimed at producing a cleaner environment, like you see on the left, or preventing monopolies. Here, Microsoft founder Bill Gates testifies about possible antitrust violations on the right. Welfare offices can be alienating places in which it is very difficult to navigate through the bureaucracy. Here, dozens of people wait to speak to counselors in Lawrenceville, Georgia welfare office. Key players in policymaking include, first, the bureaucracy. Monetary policy is influenced primarily by two bureaucratic agencies, the Federal Reserve System and the Treasury Department. The Federal Reserve System works as a politically independent branch of or office of the government. It influences interest rates and the money supply through monetary policy, and it regulates member banks. The Treasury Department is a department of the government, a part of the bureaucratic branch, and it's responsive to the President and to Congress, while the Federal Reserve System is independent of those. Remember from earlier in the book that interest groups are made up of normal Americans. In 1999, the AARP, American Association of Retired Persons, lowered the age requirement for membership from 55 to 50. You now also do not need to be retired to qualify for membership. Because of strong turnout among its members, the AARP is one of the most powerful lobbies in Washington, D.C. Now, other players and policymakers include not only interest groups, but the states. The states originally had oversight in social policy. They administer temporary assistance to needy families, TANF, or welfare, as well as Medicaid. Education policy typically is run by states through the No Child Left Behind Act, NECLP. That increased federal levels of educational policy and influence. Now, with regard to interest groups, the social policy advocates are typically less influential than other areas, but there are some exceptions. For instance, in the area of Social Security, AARP is exceptionally influential. In the area of gun control, the National Rifle Association tends to be exceptionally influential. There are alternative approaches to the policy process. One approach is called the three streams approach. Three streams. The three streams are problems, policies, and politics, and they are independent of each other. Political change creates policy windows for streams to converge and cause something to get onto the national agenda, the policy agenda. The punctuated equilibrium policy approach is when policy change often changes incrementally, and then you get to a period of major policy change where things have gotten to a point where something has to happen. Policy diffusion happens when some policies spread quickly after one state adopts them and others try to duplicate. Each of these goals that are listed on this page is laudable in its own right, but can be difficult for policymakers to achieve as they depend on population and technology changes domestically and industrial changes abroad, among other things. Nonetheless, to the extent that policymakers can achieve these goals, their ability to achieve one often comes at the expense of another. For example, economic growth tends to be accompanied by inflation. Here, policymakers have several goals. One is full employment, the other is stable prices. If you have full employment, your prices may go up because full employment often leads to inflation. Free market growth is another, a balanced budget is another, and a balanced current account, which basically is imports and exports. It's difficult to achieve all of these simultaneously. The misery index is the sum of unemployment rate and the inflation rate. Which periods have had the highest misery rate since 1960? Take a look and you'll see just after 1975 and the early 1980s, for instance, had high misery rates, whereas 2016 had a relatively low misery rate. Misery rate oftentimes is duplicated by the inflation rate. As inflation goes up, the misery rate goes up. As unemployment goes up, the misery rate goes up. Many politicians say that government spending has gotten out of control and that the federal budget deficit, the amount of which the government spending exceeds its revenue in a given year, and the federal debt, the accumulation of these annual deficits, are too high. Do you think this is true? What do the numbers say? Let's look at each of these two. Well, you can look at budget deficits and you can see that in 2010, for instance, we had a huge budget deficit, whereas in 2000, we had a budget surplus. And so, as a percentage of GDP, though, you go back to the 1940s, 1945, and we had a budget deficit that was very large as a percentage of GDP, but that was the first time we'd had a budget deficit in many, many years. We've run budget deficits in nearly every year since. Many politicians say that government spending has gotten out of control again when we look at the public deficit and the public debt. Look at what's happened to the public debt, and it's gone up in real numbers. As a percentage of GDP, public debt has gone up, especially lately. In 2016, public debt was 70% of GDP, whereas back in 1980, it was maybe 12%. The government's taxing and spending power to influence the economy is very important. There are two major schools of fiscal policy. One is Keynesian economics, where policymakers cut taxes during recessions and increase them during surpluses. And another is supply-side economics, a belief that lower taxes stimulate the economy and encourage investment. And right now we're in a period where tax policy is high on the agenda, and we can't really decide whether we want to cut taxes across the board, cut taxes to the rich, cut taxes to the poor. A lot of people say cutting taxes to the rich makes money go down to the poor. Other people say you should cut taxes to the poor and middle class and raise taxes on the rich. It all depends on how you want to look at your objectives in attaining fiscal policy. The percentage of the budget allocated for discretionary spending has been shrinking since the 1960s. What do you think? What kind of implications do you think this has for members of Congress and the president as they try to reduce the federal deficit? Well, discretionary spending is how much you have left over to spend after all of the things you have to spend are accounted for. And discretionary spending in today is about 30% of spending, whereas it was 68% in 1962. We need to look at what deficit and debt are. Budget deficits and the federal debt are related concepts that are easily confused. A budget deficit occurs when tax revenue is not sufficient to cover government spending in a given year. If tax revenue is higher than spending, then there is a budget surplus. The federal debt is the total accumulation of all outstanding borrowing by the government. The concepts of deficit and debt are related because when the government runs a deficit, it must borrow money to cover the gap. This borrowing then builds up the federal debt. You can think of this in terms of your own spending habits. Anytime you spend more money in a given month than you earn, you're running a deficit. You must borrow money to make up for the deficit from a bank, from your parents, or by running up the balance on your credit card. The accumulated sum of your monthly deficits is the total debt that you owe. However, there is one obvious point that you should be made. You cannot print your own money, unlike the government. Printing your own money is called fiat currency, and it oftentimes leads to high levels of inflation. The United States Federal Reserve Chair Janet Yellen gives her first testimony to Congress during a House Financial Services Committee hearing on February 11, 2014, a week after she became the first woman to lead the Fed. A much larger share of tax revenue comes from payroll taxes than was true in the 1960s. What implications does this have for the redistributive nature of federal taxes? That means giving back to the taxpayer in terms of services. What have been the biggest changes since the 1960s in the way the federal tax dollar is spent, and are these trends likely to reverse or continue in the next 30 years? These are things that we have to consider. You need to look at the amount of income tax that's paid as a percentage of revenue. And right now, in 2017, individual income taxes are 49% of revenue, and payroll taxes are at 32.5%. This is revenue. Corporate income tax is 10%. Excise taxes is 7.6%. Whereas back in 1962, individual income taxes were at 45% of the revenue, and corporate income taxes were 21%, and payroll taxes were 17%. They were lower, and excise taxes and other taxes were 16.6%. Now, when you look at spending, back in 1962, discretionary defense spending was at 49% of the budget. Today, defense spending is at 14.6% of the budget. So if you think that we're spending more on defense than we used to, that would be wrong. What we do spend most of our money on, a good chunk of our money on, is Social Security at 22.9% of 2017 revenue versus Social Security at 13% back in 1962. Because we have a greater number of people that are getting ready to retire. And as people start retiring and as the baby boomers retire, this is causing an explosion of Social Security payments. The top marginal tax rate, which is the tax rate paid by the richest Americans on their income above some threshold, $415,000 in 2016 for a single payer, has plummeted in the past 50 years from more than 90% to 35% in 2012, and then back up to 39.6% in 2013, and it's held steady at that rate since. There are arguments for and against increasing the top marginal tax rate. One of the arguments against is that when you increase the marginal tax rate on the rich, you decrease employment opportunities for the poor, but this in the middle class. This may be true, but still, there are a lot of people that say that the rich, that if you're making above $500,000, you're doing pretty well, and you should be paying a higher percentage of your income. Of course, $500,000 today and $500,000 in 1962 are two very different things. Open market operations have been the major tool used by the Federal Reserve since the federal funds rate effectively hit zero in the Great Recession. The Fed can do several things to try to influence money supply. One is to manipulate the reserve requirement, which is the minimum amount of money that a bank must have on hand to back up its assets. Right now, that requirement is very low. That means that banks can lend out more money. The discount rate is the rate charged to member banks, the short-term loan rate, interest rate that banks must pay on loans from the Federal Reserve Bank. The higher the discount rate, the higher interest rates are, the higher inflation becomes. Federal funds rate is the interest rate a bank pays on an overnight loan provided by a different bank. The open market operations is really where the Federal Reserve right now is focused, and this is the process that's used by the Fed to buy and sell securities. When you sell securities, what you're doing is you're taking money out of the money supply. When you buy securities, you're putting money back into the money supply. What is social policy? A narrow definition would say that social policy is a social safety net or welfare. A broader definition is that the social goals of a society are supported for public schools or job growth or a lot of different policies that are there to be a safety net. The federal government has historically paid little attention to social welfare, but from the 1960s, especially in the 1960s and going into the 1970s, social welfare increased in its importance. There are two types of social policy. One is contributory social policy or social insurance, and another is non-contributory or public assistance. Social Security is a contributory social policy. Medicare is also contributory. Disability insurance and unemployment compensation are contributory. These are similar to insurance programs in that people pay a specified amount of money to cover some future benefit, either expected as with the programs related to retirement or unexpected as with disability or unemployment. These are not means tested, and people may participate in the program regardless of their income. Whereas non-contributory social policy or public assistance programs include Medicaid, food stamps, housing assistance, welfare, and school lunches. Recipients are not expected to pay for their programs, which are means tested, meaning that they are aimed at helping poor people. The ACA, Affordable Care Act, or Obamacare, has elements of both contributory and non-contributory programs. People who are required to buy health insurance are contributing to their own insurance. However, those who cannot afford to pay for their insurance receive government subsidies and thus are participating in a non-contributory program. Civil War pensions are an interesting case of social policy. They were an important part of the legacy of Grover Cleveland, our 22nd and 24th president, who vetoed hundreds of pension bills. Excluding the fourth-term presidency of Franklin Roosevelt, FDR, Cleveland vetoed far more laws than any other president had, and he had the most per term. An interesting book about this in the beginning of Welfare State for students who want to learn more is Protecting Soldiers and Mothers by Theodore Scopel. And an interesting book for students who want to learn more about the Depression and the rise of FDR is Freedom of the Fear, The American People in the Depression and War, 1929 to 1945 by David Kennedy. Between 1880 and 1910, Civil War pensions and support for widows were there as a social welfare policy. In 1929, you had the great stock market crash. Franklin Roosevelt's New Deal alleviated social problems and boosted welfare. The New Deal expanded government's involvement in social policy from that point on. So Civil War pensions were contributory in that you or a relative had to have served in the Civil War to get the pension. Whereas the stock market crash caused non-contributory programs to increase. Before the New Deal programs in the 1930s, poverty relief was provided mainly by private charities. Here, future First Lady Eleanor Roosevelt serves meals to unemployed women and their children in a New York restaurant. Trade-offs resulting from the Vietnam War caused problems. It was challenging to continue funding the war and social policies without creating inflation. That policy of Lyndon Johnson, where he wanted to both fund the war and social policies, was called guns and butter. Many social programs were eliminated during the Reagan years, so that means you sacrificed butter for guns. And George W. Bush continued much of American social policies. He did, however, call for change in Social Security. George W. Bush called for ownership society, people taking stock or stake in the benefits that they received. The persistence of poverty motivates social policy. Over 50% of the elderly primarily rely on Social Security for their income. Increasing concentration of wealth and income in the top 10% of households has meant that there's been a disparity between the rich and the poor. It's difficult for Congress to modify, given the program's popularity and size, anything dealing with Social Security. We call this a third rail issue, meaning that when you touch it, you die, because the third rail on a subway or on an electric railroad is the one that carries the electricity. Funded by aggressive payroll tax of 6.2% and capped at $118,500 for contributions, Social Security has become the retirement plan that most people depend upon. The number of recipients for old age survivors and disability insurance has gone up and will continue to go up as the baby boomers retire. Old age insurance, which is the basic retirement program, has 43,658,000 participants. Survivors insurance, which is retirement for widowers, and the children of deceased primary wage earners, has 6 million people participating. Disability insurance, which is payments for children and their families who cannot work because of disability and are not yet retired, is 10 million, or almost 11 million people participating in disability insurance. Monthly retirement benefits for an individual are at an average of $1,336 with a maximum of $2,663. And for a couple, it's an average of $2,233 with a maximum of $4,660 if one spouse does not work and the other earns the maximum. As of 2015, the cost of the Social Security programs exceeds Social Security payroll taxes, so taxes will need to be raised to cover the trust fund's obligations and the program's ongoing expenses. What do you think are the best solutions to address the long-term future of Social Security? If you have an answer to that, you'll solve the social welfare problem of the century. Basically, the problem we have is that the current working generation funds the current retired generation, and with more people from my era, the baby boomers, retiring and less people working, that puts more responsibility per worker financially. So right now we're paying more than we're taking in, and we can't continue that, or you'll have an explosion of Social Security in the future. Social Security faces a long-term problem. As demographics change because of its pay-as-you-go structure, it's exacerbated by the size of baby boomers, the baby boomer generation, creating an international transfer of wealth. Solutions range from shifting regressive payroll taxes to a flat tax to cutting benefits or privatization. Healthcare systems are composed of several sources. You have private insurance like Aetna, Humana, Blue Cross, Blue Shield, and so forth. You have charities or donated care. You have out-of-pocket payments, people who pay as they go. And you have government payments, including Medicaid and Medicare. Medicaid provides health care for low-income families. Federal program is a federal program administered by the states, which set guidelines. And Medicare is a federal program that provides health care for retirees. Funding for our current healthcare system comes from a variety of sources and is spent on many types of care. In an effort to slow the increases in healthcare costs, which areas should receive the most attention? So look and you see that out-of-pocket care, people who pay as they go, it's about 12.9% of funding. And private healthcare insurance is 33.9%, Medicare is 22%, Medicaid is 17%, and other health insurance programs is 13%. Now, hospital care is 32% of the cost of the spending. Physicians and clinical services are 22%. Nursing home, home health, and other residential care is 16%. Retail sales of prescription drugs and medical products is 13%. Program administration and the net cost of health insurance is 7%. Research and equipment is 5%. Dental services is 3.7%. Medicare premiums for 2016, you have Part A, which is hospital insurance, Part B, which is medical insurance, and Part D, which is prescription drugs. Most people do not pay for Part A premiums because their spouse has 40 or more quarters of Medicare covered employment. Part B, medical insurance, is $104.90 a month. Part D, prescription drugs, varies by plan, $41 per month in 2016 and an additional $13 to $73 a month depending on the income level. 95% of people will pay between $13 and $33. Now, when you look at Medicare deductibles and coinsurance amounts, Part A Medicare pays all covered costs except a deductible of $1,200 during the first 60 days and coinsurance amounts of up to $315 a day for days 61 to 90 of a hospital stay, and $630 a day for up to 60 lifetime reserve days that can be used at any time during one's lifetime. There are no costs beyond 150 days that are considered. Part B is $147 per year and then 20% copay after meeting the $147 deductible. And Part D is a maximum of $360 a year and then a 25% copay of the first $3,310 of drugs. The beneficiary then pays 45 to 58% of the next $1,500 of drugs after a $4,850 out-of-pocket annual limit is reached. Medicare pays 95% of all the cost of drugs after that $4,850 out-of-pocket limit. So Medicare is, for most of us in our retirement, is what we depend on. This is a cartoon that says, well, everybody's in Congress is looking at Social Security, and that's the little bomb, whereas they're standing on the big bomb, which is Medicare. The problem is not Social Security. The problem is Medicare. The cost of Medicare is much greater than the cost of Social Security. The unfounded liabilities for Medicare are estimated to be about 6 times as large as the Social Security shortfall. But Congress has a very difficult time acting because any solution involves politically unpopular combinations of tax increases and benefit cuts to the elderly. And the elderly vote. Though few issues have been as contentious as health care reform, social policies can be complicated, conflictual, and personal. The political process used to tackle these conflicts is often tedious, complex, and time-consuming. Opponents of the Affordable Care Act want to repeal and replace it, but attempts to repeal it have been very unsuccessful. Moreover, being able to replace it with a viable plan is even more unlikely. So you have the Patient Protection and Affordable Care Act, or ACA, or Obamacare, which was signed into law in 2010, which provided comprehensive coverage, required electronic medical records, and comparative effectiveness research in order to lower costs. The law has proven controversial. It was upheld by the Supreme Court and has had a variety of implementation and information technology problems, but it's likely to survive in some form, and it has. Political philosophers, who are very different from politicians or political scientists, debate the morality of universal guaranteed income. This is an amount of money that would be paid to people just because they're human beings. In a widely used example, someone could simply be a surfer, whether on a beach or on the internet, and they could get paid. A version of this exists in just one state, Alaska, though its Alaska Permanent Fund, which sends citizens an annual check based upon oil revenues taken in that year. But the check is much too small to live on. Its size fluctuates with the price of oil. Most people, however, believe that society's support should be used for only certain things like food and medical care, and become upset when funds are reported to be used for non-essentials like alcohol, cigarettes, and this is why we have food stamps instead of merely sending people checks. And now we don't even have food stamps, we have benefit cards. But they're still fraud. Income support and welfare. Welfare is the specific program of cash support for those who cannot support themselves, temporary assistance for needy families, or TANF. Income support is generally the term for the provision of support for low-income people with many forms of different aid. That's different than welfare. Supplemental Nutritional Assistance Programs, or SNAP, is the government-issued coupons that can be used to buy groceries, food stamps. Unemployment compensation is temporary and partial wage replacement. The Earned Income Tax Credit gives tax credits to those who do not earn enough to pay income tax. And welfare has 2 programs. Aid to Families with Dependent Children, or AFDC, was the program from 1935 to 1996, which became TANF, Temporary Assistance to Needy Families, from 1996 to the present day. The social policy safety net is supposed to protect poor Americans during periods of economic recession. A deep recession happened in the early 1980s, and another recession during the time frame depicted here was in the early 1990s. To what extent did the safety net accomplish that for which it was intended? So you had, if you look, as you go into recession, you had Medicaid, food stamps, earned income tax credit, supplemental security income, and AFDC. AFDC's gone down, and TANF has gone down, whereas the others have gone up. Social policy today in education is largely dominated by state and local governments. They are the ones that are responsible for delivering educational services. Federal involvement in higher education started with the Morrill Act in 1862 and the GI Rights Bill in the 1940s. Federal forays into K-12 education include Elementary and Secondary Act of 1965, the No Child Left Behind Act, and Race to the Top. Let's see how things work in theory. During the budget process, the first Monday in February, the President submits a budget request to Congress. On February 15th, Congressional Budget Office, or CBO, issues Budget and Economic Outlook Report. Within 6 weeks of the President's submission, other committees with budgetary responsibilities will submit views and estimates to federal committees. In early April, the House Budget Committee creates its budget resolution and the House votes on it. In early April, the Senate Budget Committee creates its budget resolution and the Senate votes on it. Now, this is in theory. In early April, the Budget Conference Committee reconciles the House and Senate versions of the budget resolution. By April 15th, the House votes on conference version and the Senate votes on the conference version. And afterwards, you have appropriations that are given to the different branches of government in the bureaucracy. And by October 1st, you have the start of the fiscal year. And back again, you go to the first Monday in February. In practice, let's look at 2016. In March, President Obama submitted his budget for the 2016 fiscal year and signed his last appropriations bill from the previous year. On March 25th, the House passed a budget resolution, and March 27th, the Senate passed a budget resolution. So far, so good. So on April 30th, the House passed a conference report that worked out the differences between the House and Senate budget resolutions. And on May the 5th, the Senate passed a conference report. This is the first time in 6 years that a budget resolution had actually been passed by Congress. Before that, they had been depending on continuing resolutions. But there was a twist. On July 28th, Representative Mark Meadows, a Republican of North Carolina, introduced a measure to remove Republican John Boehner from as Speaker of the House amid tensions between the Tea Party wing of the Republican Party and the establishment conservatives. Pressure was building, and in August, pressure on Boehner built through the summer, and a floor vote on his status as Speaker became more likely, and he was removed. September 18th, House Republicans voted to defund Planned Parenthood, with some Freedom Caucus members threatening to shut down the government on September 25th if their demands were not met. Boehner stepped down September 25th as Speaker because of the split between the party over the budget. Between September 30th and October 1st, Congress passed a continuing resolution with a few hours to spare to keep the government open. On October 29th, the new Speaker, Paul Ryan, was elected and vowed not to shut down the government. On October 31st, Congress passed a budget agreement raising the debt ceiling and agreeing to spending targets. Between December 11th and December 16th, Congress passed continuing resolutions to keep the government open. December 18th, 2015, Congress passed an omnibus spending bill authorizing $11 trillion in spending and $650 billion in tax cuts. And this is the end of Chapter 14.